Welcome, traders. Tonight's meetup is Stop in the name of the trade, and we'll be discussing the many facets of using stops for exiting your trade. Before we begin, we just got to kind of go over the disclaimer. This webinar is for educational purposes only. I'm not a licensed financial advisor, and trading can involve risk. Nothing you don't already know. Tonight's meetup, we'll be talking about the different types of stops that are available to you, how to determine the best stop price, and the different stop systems that are available that you can use to help manage your trade. This is a quote that I found that I thought was relevant to the meetup. Time in the market is more important than timing the market, meaning that managing your trade is better than trying to find market tops or market bottoms. So why do you want to use stops? Well, in general terms, stops are used to trigger a buy or sell action of a security. Stops can be used to enter a trade, but we'll be discussing them on how to use stops to exit the trade. As traders, we want to use stops to manage risk, reduce stress and emotions, and maximize profits. Before entering a trade, you should know where your exit price should be. This exit price reflects a point when it no longer makes sense to stay in the trade. Knowing this price prior to entering the trade, you've defined your maximum risk per share. Having the stop placed at that price ensures that the order is submitted to exit the trade. Without a stop in place, you are subjecting yourself to stress and emotions. You'll have to watch the trade constantly in order to make a decision about exiting the trade. If you're watching price go against you, you may panic and get out of the trade too soon and miss a reversal. Or worse, you could even watch it fly right by your exit price. And instead of making an exit, you may begin to hope and pray that it comes back to that price. Once the trade starts to go your way, you want to stay in the trade as long as possible, but you don't want to lose any profits that you've made. To do this, you'll have to adjust your stops often to capture as much profit as possible while giving your trade room to continue to grow. Stops are placed in below a price in a bull trade and above price in a bear trade. When placing your exits, you'll likely use one of the four types of stops, and that is a stop order, a stop limit order, a trailing stop, and a criteria-based order. The stop order is also known as a stop loss order. This type of stop submits an order to exit the trade as a market order once the price specified is met. For a stop which is selling to close the position, the stock price must be at or lower than the stop price to trigger the market order. For a stop which is buying to close the position, the stock price must be at or above the stop price to trigger the order. As with all market orders, brokers will attempt to provide customers the best available bid-ask price when the order is received to exit the position. Market orders are executed as fast as possible based on market conditions. While an order may be triggered based on the stop price condition, factors like the size of the order, news reports, rapidly changing market prices can result in the order being filled at a different price. This difference in price is known as slippage. Some examples is if you have a stop at a price that's below price, and overnight the price gaps down, which is significantly less than your stop price is still going to trigger, but it's going to trigger at the much lower price, and that difference is what's known as slippage. Here's an example of a stop order in the Thinkorswim platform. You have your order type to the left, and it's just a basic stop. We're going to sell 100 shares to close the position. We're going to trigger, the order will get triggered at $33.17. This is known as the trigger price. And you've got the duration. Now here it's just defaulting to day, but with stops you're typically going to want to use the GTC, or what is known as good to call. This keeps the stop order in place as long as the trade's active. This provides you, so if you can't watch your trade, your stop is still in place, and if trade goes against you and you're not near a computer or you're not watching the markets, you're still going to get pulled out of your trade at that price, or the order is going to get triggered at that price, and then they're going to try to fill it at the best market price at that time. Just to kind of show you an example here on a chart. So here, let's say we're in the trade and, we're just going to use some candlesticks to determine our stops. And, here might be the stop that we want to set it at, gives us a little room to kind of do a pullback. And let's just kind of watch the trade a little bit. So you can see we would have gotten stopped out right away at this 69.71 once this came down. Now if we watch the trade, it goes up, but we would have been stopped out here. And depending on when we got this trade, we would have made some decent profits. Now, however, let's say, we were being really kind of loose with our stops because, we wanted to plan to be in this trade for a long period of time. So we set it down here at the low, at the higher high over here. So we kept the stop price here. We would have noticed that we would have gotten triggered at this candle over here. Now, if we would have had, let's say for some reason, we determined that the price we needed to get out was here based on these candles over here. We set the stop price here. Price on this day was above our stop price, so it would have never gotten triggered. But overnight, price significantly dropped well below our stop price. So our order still would have been triggered because price was at or below this value, but it would have gotten probably filled somewhere down in here. Depending on the volatility, it might have been a little bit lower depending on what it did when it opened up. If it shot straight down, we even might have got a lower fill value. So it could have been somewhere in this range. So it's just, something that you need to be aware of, that even though it's a market order at this price, you may get filled at a completely different price depending on market conditions and when the trade is actually executed. So the next type of stop order that we have is a stop limit order. These are used to buy or sell a security at a specific limit price once the security has traded at or above a specified stop price. The stop limit orders requires two sets of prices, the stop price and the limit price. The stop price is used to trigger the limit order. The limit order is the value or price you want to exit the trade at. The stop price may be the same as the limit price. However, you may want to give a little bit of padding prior to the limit price in case that there's a lot of action going on. You want the order to be triggered and sent, so it's there waiting to be filled prior to price getting to that point. For smaller stocks, a few pennies is often enough. For larger or more volatile stocks, you may want to give several pennies, dimes, quarters, depending on the scenario and the market condition for that stock. As with all limit orders, brokers will attempt to fill the order at the specified price and only that price. While the order may be triggered based on a stop price condition, market volatility or price gaps can result in the order not being filled. This in turn can create a much bigger loss than the regular stop order. Here's just a sample of the order in Thinkorswim. So again, we're trying to sell 100 shares. We've set the stop to be a stop limit. And you can see that there's those two prices. We have the stop price and the limit price. So the stop price will trigger the order at $33.20. So assuming that this is a bold trade, so that we are expecting price to go up, and if price is coming down, the 33.20 is going to get triggered prior to the limit price. This gives it a few cents, gets it to the broker, and the broker knows that at 33.17 I need to try to fill this stop order at 33.17. Excuse me. Again, you still have your duration. In this instance, I actually clicked on good to call. So this would stay in place until I canceled the order or the order was filled. So if we look at this in charts again, if we had let's say a limit order right here, based on these candles, we said, well, if it really kind of dips down below that, I want to get out of this trade. Well, here's the first candle that did that. And depending on the market volatility, this is close to being the open. And, if the open can be very volatile and can, have huge swing prices. So it could have gone up and then it could have just fallen straight through and never came back through this price. Well, in that scenario, if it had done that, this order could have been not filled because the volatility was too quick and they couldn't get 100 shares filled at that price. By the time they finally got to that order, price was well beyond the specified limit price. So with the limit price, they'll guarantee the price will be, that if they fill the order, it will be filled at that price specified, whereas a market order, it guarantees that it will be filled. So then the other concern that you have with stop limits for stops is that, in the same case here, if we're past this value, we're not going to get filled down here. We would actually have to know that our order is not going to get filled and we're going to have to cancel it and actually send a market order. And let's say if we're out of town for that week or something, we don't have access to a computer, we don't know anything about it. Next thing you know, we get back and boom, we're now down another $1 or two. So stop limits aren't really the best use for getting out of a trade. They're good to get into a trade, but for getting out, I think you'd probably want to try to stick to, typically market orders for that reason. Next type of order that you have is what is known as a trailing stop. These orders are similar to a stop loss or a stop limit order and can be set up to use either one of those types. The difference with the trailing stop is that it doesn't need to be managed as closely by the trader. With the trailing stop, you define the risk at the beginning of your trade and set the trailing stop by that amount. This amount can be defined as a dollar amount or as a percentage amount. Whatever one you use, that value represents the spread from the entry price and will remain constant throughout the trade. As price moves up in a bull trade, the trailing stop price moves up the same amount. So if the price saw like 50 cents higher than any previous high, your stop is going to move up 50 cents as well. However, if price reverses in let's say a bull trade, the trailing stop doesn't go down. So if let's say it hit the 50-cent high and came down 25 cents, well, your stop didn't move. It moved up to 50 cents, but it stayed constant. So if your trade came down 25 cents, 50 cents, 60 cents, depending on what your spread is to begin with, the trade may or not trigger, but whatever that high was for that stop, it's not going to change. It's going to remain constant until price hits another high, and then the stop will move higher with that higher high. This type of stop allows the trader to set the risk in the beginning and let the trade continue without further adjustment or consideration. Basically, it's a set it and forget it type of stop. Looking at a sample of an order in Thinkorswim, the order type you can see is a trail stop. The trailing amount is set at like 0.1%. That's really small. That was just the default value that the system put in. Depending on the volatility of the trade, you could have that as 1 to 2%, depending on what you need. The trailing stop type is percentage, as you can see over on the right-hand side, but you can change that to price or any other type of value that you feel pertinent to the trade, that type of trader you are. And again, you have the duration. Good to call is typically what you'd want to use. And again, since it's like set it and forget it, you really don't need to come back to it. You just leave this until it's filled. So if we go take a look at the charts, Look at Apple again. So in this instance, we say, let's say we want to get into this trade above this candle here because it represented a gap play. And once we do get into the trade, we want to set our stop to be just below that. So you can see that the stop then is about $1.50 spread here. So if we get triggered into this trade, we want to put a stop price of $1.50, and that will be our trailing stop for the rest of the trade. So as the price goes up, our stop will always be $1.50 behind it. So we just kind of watch it go in motion here. So when price hit a new high here, the stop would be moved up $1.50 less than this value here of the high, which is 64.28. So the stop in this case would be 62.78. Excuse me. So it would have been moved up to here just by following, just by with the trailing stop, you know, and it would do that for each day. So this hit a new high up here of 65.31, so it would have been 63.80. Somewhere right in there. So that would have been your stop. Now you see that here, looks like we went 2 cents higher. So I was already at 280, so 682 is there. And then the high was lower here, so 65.26. So the stop did not go up any higher here, but it also did not go down, even though that stock was in that area. So now stock went up again, went up. So this is the highest point now at 67.41. So that would be 65.90 approximately. So that's our new stop. So we saw that price went down and actually hit a little bit of lower, but our stop did not change. So that right here is when we would have, our stop would have triggered on this price here. So you can see that stop move up with the trade, and then once price stopped going up, the stops, you know, the stop stayed constant at that the highest price. So when the price, the stock price came back down, it triggered the stop and got you out of the trade. Now this is like, for Apple, that's kind of a tight spread because, you know, it has a lot of volatility. And we'll discuss it, how to adjust that later on in the seminar, but, you know, it's just kind of an example of how to use it. Now, the last type of order that you have is a criteria-based order. These are complex orders that are used to create stops based on a wide array of data. You know, whether it's indicators, you know, stops, maybe prices of other securities, you know, if you're basing it on the QQQ. These criteria-based orders can use a large array of data to create sell orders. Some platforms have an area called conditional orders, which provides a minimal level of criteria-based orders. Other platforms provide a structure which a trader can create automated scripts which will allow you to create and buy sell orders on demand based on indicator values and the parameters that you set up without you having to do anything. Now, as an option trader myself, I typically use a criteria-based order because I don't know the price of the option when the underlying stock hits a target or a stop price. So to create an order to exit out of the position, I create a criteria-based order which sells the option when the underlying stock hits a specified price. So in this example is a criteria-based order that's available in Thinkorswim. And up above you can see that I'm selling an option. I'm selling 10 contracts. It's good for the day, but again, you'd probably keep it as a good to call. And I'm selling it at market value. Now there's some ways that you could probably guesstimate the best limit price. But for this scenario, we're just going to sell it at market. And the criteria area is actually down below. So as you know, option prices are significantly different than the stock price. So, but we want to get out at a certain stock price. So down below, I set Intel, and I want the trigger to fire when price is at or below $31. So when price hits $31 or below that, it sends this order to sell 10 shares or the 10 contracts at market value. And you can also set up different parameters like the time that the order is submitted, so you can set it after the largest volatility of the day, which is usually the morning, or you can cancel the order, based on other criteria. So those are the types of stops order types that you have available. So now the next thing you need to do before you get in the trade is determine the stop price. When trying to figure out where to place a stop, you want to put it in a place where the trade no longer makes sense to stay in that trade. This price reflects the point where you accept that your analysis was wrong and the trade is no longer valid. The type of trader you are will influence the stop price and how far it is away from the initial entry price. For long-term traders, they'll want to have a large spread throughout the whole trade. This will provide them more room for the trade to move through its normal cycles. Scalpers, on the other hand, will want to keep their stops much tighter to get them out of the trade quicker. One of the most common ways to set a stop price at the beginning of the trade is to place it under a support area in a bull trade or above a resistance area in a bear trade. These support and resistance areas can be based on past price support and resistance zones, trend lines, candlesticks, or even indicators, for example, moving averages. Once you've determined your entry price and exit price, or known as your stop price, you have determined your maximum risk per share for the remainder of the trade. So if you look at this on the chart here, if we go back to our trade, if we have our initial analysis, we have our little trend line here, put in some support and resistance zone lines here, usually at gaps, highs of this range, maybe even up here. So if we got into this trade here, initially we used the gap area. So we said anything below this area underneath this gap, it no longer makes sense of the trade because now we've kind of we've gone below the high of this point here. And we've also crossed into a gap area, which usually signifies that it's going to fill that gap area. So our initial trade setup was said, well, we don't want to be below that price. Get a little closer here so we can see it. So initially we set our stop loss here and we got into the trade here. Now, so this here is underneath a support zone of prior price action. We could also say that, well, here's a trend line kind of created by these 2 points here, and the trend, has been confirmed here. So we may not want to set our stops, much lower, let's say down below a trend line. So as price moves up, we just kind of move it up along this trend line. So if we do that, you you'll see price go up. You're just kind of following it up along the trend line. It's continuing, and you're still moving your trade. your stops up along this trend line. So, you're kind of keeping in this trade with the trend. Kind of the problem with that though is when price does really kind of pull away, you've got a large area of profits that, if this were to come straight back down, that's a lot of profit you've kind of left on the table. Another option that you have is to follow candlesticks, so let's get rid of some of these here. You kind of want to just take lows, prior lows is what your support is. And then as the trade goes up, maybe you move it up underneath this candle. And, then maybe you kind of put it here, kind of around this previous high. And, if you want to get really tight, you could, move these up to candles up here or even up here. So you'll get knocked out much sooner. But if this trade continues on, then it, that's more profit that you could have realized if the trend had kept going. So, but, these are kind of signals that, maybe you saw signals that the trade is about to reverse. So, you felt comfortable that getting out here or somewhere up in here, is valid. That's a decision that you have to make as an analysis. Or maybe you even saw that said, well, this is my first target up here, and price hit it here and then came back down, and you're like, well, that's fine. I took all my profits at this point. And another way you could look at it is using moving averages, and you set the stop below those moving averages. So those are some different ways that you can use it to determine what your stop price will be. So you've determined your entry price, and you determined your exit price, and so that determines your max risk. So you determine that, well, that's a viable risk to reward, and you're happy with that. So you get into the trade. Well, once you get into the trade, you need to manage your stop losses. So hopefully the trade moves in your direction, and you want to move your stop losses along with that. By doing that, you're maximizing your profits and minimizing any losses. There's only one real rule though when you're making adjustments throughout the trade, is that when it comes to adjusting your stops, you never loosen the stop. And I mean ever. So once you know your maximum risk, that is the most you're ever gonna lose in the trade. If you start loosening your stop, it's usually a sign of poor discipline, and that you're letting your emotions control you, which often leads to greater losses. If you feel that your analysis was wrong and that your exit price was way too tight, just accept it and make a note in your trading journal, and document why you felt you were wrong and how you feel you can correct it in the future. So that way you have documentation, so that when you come back and analyze the trade later after you've gotten out of the trade, you'll be looking at it without any emotions. And then at that point, you can determine whether or not your initial analysis was right and your emotions were controlling your judgment, or that, yes, in fact, that you were being way too tight, and you can adjust your future trades by doing the suggestion that you provided. But you don't want to be doing it in the middle of the trade, because that's when your emotions are your highest and you can make bad decisions. As I said, you want to adjust your trades in order to minimize losses and maximize profits. Any adjustment should only make your risk smaller until the trade becomes profitable. At that point, you're just adjusting your stop to maximize profits. Your initial goal is to adjust the stop with the trade towards the break-even point. You don't want to do this too soon in case the trade retests the support resistance area at the beginning of the trade. This is very common, especially when you're getting in at certain areas. It likes to come back and retest it. And if you follow your stop too quickly, you could get stopped out well before the trade really starts getting going. However, once you get to the break-even point, you have guaranteed that guaranteed that you're basically going to have little to no loss. Everything beyond that point is all profits. You've protected your capital, and now you're just going to be working towards to maximizing the profit potential. There's not, and I can speak from this from experience, is that there's nothing worse than having a bunch of profits on the table, not adjusting your stops, and seeing it all loss and actually lose money because you didn't change your stop. While you want to maximize your profits, you don't want to set the stop too tight, as you may be stopped out too soon and miss a large portion of the trend. You'll also need to account for normal volatility associated with the security you're trading, and this will vary greatly between stocks and other securities. So like I was kind of showing you previously with Apple, Apple has, $1, $2 swings, no problem. So having a trailing stop of only $1.50 doesn't give you a lot of wiggle room for this, the trade to kind of pull back or, see any type of larger volatility. Now your trade's been going your way for a while, and you're nearing your target level. So now what do you do? Well, one option is to exit the trade at the expected target level and take all profits. Since you'll have two stop orders, one will be at the target level and one will be at the stop loss level. You'll need to do that. You'll need to set up a one cancels the other order, or an OCO order. When one of the order stop price is hit, it triggers that order to execute, and then the other order automatically is canceled. This allows you to protect you from price going against you, or to take in max profits based on your targeted price projection. And this allows you to set these stops up without you having to be around and managing the trade. You set them like the night before, or a couple days before, and just let the stock move to one price or the other, and one of the orders will trigger and the other one will be canceled. Another option that you have is to take some of the profits off the table at the target level and then change your stop type to a trailing stop. This allows you to realize some of the profits while keeping your trade on in case price continues to move in your direction. As you near your target levels, you may want to tighten your stops even more, especially if you become nervous. This nervousness could be a result of you seeing an increase in volatility due to news or some other external events. And you might also want to tighten stops if you start to see warning signs in the candlesticks that are being created. These often give a good indication that the trend is weakening or even reversing. Again, they're only warning signals, so you got to take them with a grain of salt, but they can be warning signals that prevent you from losing a lot of losing a lot of your profits that you've made. As stated, you'll want to adjust your stop once you're in the trade, but what price do you adjust your stop to? There are several different techniques that you can use to help determine that price. Some of the most common stop techniques or systems used to adjust the stop price are as follows: moving averages, parabolic SAR, trailing stop, trailing candles, other indicators or the criteria-based orders, and a best guess. Other indicators might be used, or a common of indicators could be used based on your strategy. But unfortunately, some of those, if you don't have a system that you can create automated scripts, you'll have to kind of manually figure out the system in your head each night and apply the stop price to the stock the next day, according to your rules. So it can be a little more complicated, but you can build a strategy based on multiple indicators. It'll just be a little bit more work for you. And while best guess is an option, it's not something I would really suggest unless you're, a really skilled trader and can read the charts really well. This is really for people who've been trading for many years and, are successful and really understand what they're doing day in and day out. So let's go to the first system. This is one of the popular ones, the one that I've kind of started to look at a little more closely. This is the moving averages. In general, moving averages represent the average of the stock price. So using a moving average to adjust the stop price makes a lot of sense because they're already following the price. I prefer to use the exponential moving averages as they are more responsive to the current price. And some of the common exponential moving average values are the 10, 20, and 50. If you're a long-term trader, you might want to consider the 100 and 200-day moving averages. The moving average will represent a support or resistance zone. As such, you'll want to set the price below the moving average in a bull trade and above the moving average in a bear trade. Now, if you use the moving averages to adjust your stops, it's important to recognize that the moving average the stock adheres to. Some stocks may follow the 20 EMA better than the 10, and some may really follow the 50 better. Knowing this will allow you to adjust your stop accordingly and not get stopped out too soon. In the beginning of the trade, you probably want to keep your stop under the larger moving averages because at that point your moving averages are probably going to be a lot tighter. So they're all going to be kind of laying on top of each other. And so they're all going to be very close. So it's just better to kind of keep it under the 50 because the bigger moving average it is, the more support it really provides to the price. So in the beginning, it's probably a little bit safer to keep it on a larger one. As the trade progresses and the moving averages begin to pull apart, you can start using one of the faster moving averages, probably a middle one, to set the stop price. If the price really starts to pull away, then you'll want to move to the fastest moving average. And if you're nearing your targets, you could even switch to a shorter time period, which will make the top even start tighter. And by switching to a shorter time period, I mean, if you're in a end of day trader, so you're basically trading off of day candles, you can then switch to a 4-hour chart or maybe a 2-hour chart or something like that and go off the moving averages there and set the adjustments based on that because they're going to be a lot closer to price than a daily chart will be. So, but just realize that you're probably going to get stopped out much sooner. So just be aware that, you know, if you're really trying to maximize profits and you feel that it's really kind of coming near an end, that might be a good way to maximize those profits. While you can use the moving averages to determine your stop, you don't want to use the moving average itself. You want to set price to be somewhere above or below the line to account for normal volatility. This will prevent you from getting stopped out when price tests the moving averages. Basically, when you see a wick kind of go through a moving average, or it might even close a little bit below the average and then the next day go up right up above the moving average. So those kind of just price testing the moving average. So if you set it on the moving average, you're going to get stopped out and price could continue along. To prevent that, you want to try to, like I said, put the price below the moving average. You can use your best guess to place the stop under the moving average. However, if you want a quantitative way to determine the stop price, you can use the average true range. To get your stop price, the first thing you want to do is find the ATR for the interval you're using and divide that value by 2. So if you're using a daily chart, you find the ATR for the daily chart, divide that value by 2. So if it's $1, your value that you'll be using is 50 cents. So then you find the exponential moving average that you want to use for your stop. So if it's in the beginning of the trade, it's the 50 EMA. And let's say that's at $45. You subtract the ATR price that you've just found out, which was 50 cents, so your stop would be 44.50. This will give you the stop price in a bull trade. Now in a bear trade, you want to actually add the ATR, the result, to the exponential moving average. So if your EMA was $45 and price is below that, your stop price would actually be 45.50 because you're adding the result to the moving average value. Let's just take a look at that on how that really kind of works out on a chart. So we got into the trade here again. So our initial stop is going to be below the 50 because that's kind of the beginning of the trade. So we got in the trade right here, and we need to get the ATR added to the chart here. So So that was our entry price. So on this day, we figured, I'm just writing it for there for now. So the candle that we got on is on July 29th, and the 50 moving average kind of looks like it's the 61.37. So get our calculator. 61.37. We want to subtract the ATR for the day. So if we come down to the ATR, and we're looking at $1.43, which is, about 71 cents. So did I say it was $1.43? So 1.43, divide that by 2, 71 cents. Subtract that from the moving average. So our first stop price is $60.65. So let's adjust that. So on that first day, that is our initial stop price based on the moving average. So now the trade moves on, and you keep adjusting this for each day, but for like these candles here, you still may kind of keep it underneath the 50, but you've really kind of started to pull away, at these candles. So you may want to start moving to the 20 EMA. So on this candle, we're going to start using the 20 EMA, and we can see that the price here, up here, is this middle one. So we're looking at 63.07. Subtract our ATR, which is $1.07 for the day. Divide that by 2, which is only 53 cents for the day, and that's our average true range now. And so our stop price now becomes 62.53. So for that candle, we kind of move it up here to 62. I can't really get it exactly. So that's now our stop price, is right there. And you can kind of see that, price came down. And, if we look, if we keep adjusting this each day, the moving average up here was 63.99. The ATR was 98 cents. Which is only 49 cents there. So now, right underneath this candle, our stop loss would have been 63.50. So somewhere in there. So now a couple days later, this candle really took off. So, and you can see that the moving averages are really starting to spread apart. So now we may want to say, well, let's move our stops up to the 10 EMA so we can try to capture as much of that profit. So, let's say at this candle here, our EMA is at 65, or actually we're going to the higher one now, which is this one. So we're looking at 67.90. Minus the ATR, which is $1.81. So the ATR has really jumped because we've got a lot of volatility back here. So $1.81. Oops. Divide that by 2. Gives us 90 cents. And our stop for 66.95. So underneath that candle, it was 66.95, right in there. So then let's say up on this candle here, this will probably be the last one that we'll do. Moving average is 70.85. The ATR is $1.09 divided by 2. So now our stop would have been 70.35, I think it was. So right on the next day, we would have gotten triggered out. But you see that we caught most of this move up, and we're protecting ourselves from it kind of going further. Now, if we were to watch this, in this case, I know it goes up a little bit more, but then it comes back down. So this was actually a pretty good stop area of stop. Came back and retested resistance, and boom, it came down. So, but that's just a really good example of how you can use moving averages to try to capture as much of that gain. Now, with this big move here, you could have tried to go to a shorter time period to try to capture, get close to the trade, but you're still getting a lot of volatility, so you could have been stopped out a little bit earlier up here. So just kind of be aware of that. So that's the moving averages. Another system you can use is the parabolic SAR. This was an indicator that was created by Welles Wilder. The SAR stands for stop and reverse. It was initially developed to be a standalone trading system. However, it doesn't really work well as a trading system. So basically what happens is the indicator places dots on the chart, and it places it up above or below a price candle. And if the SAR dot is below price, it means you're in a bull trade, 100% in. And if it flips over to be above the price, then you're in a bear trade and you're 100% in the bear trade. So the problem is that it can really create a lot of whipsaw. But however, in a trending market, it can provide a nice, easy way to find your stop loss. As I said, the SAR kind of works well in a trending market. As a trend progresses upward, the SAR moves closer to the price. This is done based on an acceleration factor that's built into the indicator. As I stated, it provides an easy way to determine stop price without using any math. You just need to glue the indicator to the chart and set your stop based on the last dot drawn on the chart. Problem with this system is that the SAR can stop you out a little earlier if the stock experiences a minor pullback further into the trade. So if it happens early on, you've got a kind of a larger margin of error in the beginning of the trade, but as the trade continues, the SAR is getting closer and closer to price. So if there's any minor pullbacks, it can stop you up because the SAR is a lot closer to price. You can offset that by adjusting SAR parameters. Well, that might work great for the longer trades. Any shorter swings, like I said, have a wider margin. So you could actually end up not realizing a lot of your profits. So if the price goes up and comes right back down, it has a large area to fill before it gets stopped out. So let's take a look at it on a chart here. So we're already kind of looking at it, and we saw how to use the moving averages there. So let's just kind of apply the parabolic SAR. So you see that we got kind of stopped out way up here, right? We got in the trade here. So in this example, we would have actually captured more of the price because we would have gotten stopped out up here. Not by a lot, but it would have gotten us a little bit better. Now, however, if we look at a different solution or different chart, We're saying we want to get in the trade above that resistance zone. So now we're in the trade, and you can see the SAR is being plotted. And at the beginning, it goes to the previous low, swing low. And at the beginning, you've got a lot of room here for that trade to kind of pull back before the stop is hit. And you can see it's getting closer and closer to the price. So at this candle, your previous stop would have been here. And so once it triggered here. But at this point, you would have gotten triggered out here. Or, and you would have missed this big gap up. If we were to follow on the moving averages example, if I remember correctly, we would have been safe at this point, because we would have been kind of under the 20 EMA, and we would have been safe at that point. So it would have kept going, and I think we would have gotten triggered out somewhere up in here. So using the SAR, we would have gotten triggered out once, twice, before using the moving averages getting triggered out somewhere up in here. So to kind of offset that, like I said, you can edit the parameters. So here you can see the acceleration factor is 0.02 with a maximum acceleration factor of 0.2. You can adjust any of the ones, but if you set that to 0.01, you can see that the values come down a little bit, and you don't really get set until out here. You could even set the maximum acceleration factor to be no more than, I think it's 10 or 0.1. So that's the maximum variation that it would keep away from that price. So it does protect you from these areas here and gives you a little bit of a nicer trend following system. So it gives you some room for those little minor pullbacks that you'll normally see within a chart. So you want to try to not get stopped out at those and just continue on with the trade. But if it does start to show some weakness, like kind of did here, it is good to get out. But you can see that the market really just took off again. So this was just ended up being another minor pullback. And not every system's going to be perfect. I mean, even the moving averages, if you switch to the 10-day, you could have been stopped out here. So it's just a matter of figuring out what system's the best. And it's also good to try different ones out for different stocks. Some stocks are a lot more volatile than other stocks. Like Apple has big price swings. So, maybe the parabolic SAR isn't good for that, and moving average is a little bit better. That's just something you've got to play with and try to, determine what's best for you in your trading strategy. Another system that you can use that we've already talked about is a trailing stop. Once you create the order, you just determine the initial buffer. The order then automatically adjusts the stop price for you. As a price reaches new highs, the stop price is moved up that same amount. This makes managing stops really easy and is ideal for the trader who doesn't have time or the desire to directly manage their trades. The problem with trailing stops is that the stop price doesn't account for volatility. Once your initial buffer is set, it remains constant. This can make it difficult to determine the best buffer to use. Set it too tight and you get stopped out too early. Set it too loose and you leave a lot of profit on the table. To help offset this, you can use the ATR again to determine the buffer price. You'll take the ATR at the time of the entry, multiply it by 2 this time instead of dividing. You multiply it, then subtract it from the entry price. This will give you a good buffer for the stock price to have some wiggle room throughout the trade without stopping you out. Now, as a trade moves on, you might want to consider to decrease that buffer to maybe 1 ATR or even a half ATR, depending on how long you've been in the trade. Again, this is subjective and you are risking the possibility of getting stopped out much sooner. However, if you've been in the trade for a while and has been increasing for some time, reducing the buffer will help capture more of the profits when the trade does decide to reverse. So in summary, we've talked about the different stops, how to determine the stop price, and how to adjust your trades throughout the thing. And the purpose of doing all this is to help reduce your stress and the emotions that you would feel during a trade. having these stop prices, you understand what your maximum risk is, and you can see your potential profits that you're gaining each time. And once you set those stops each night, you know that, hey, I just made another $50. I made another $100. I made another $10. That's a good feeling knowing that no matter what happens tomorrow, unless it's a big gap or something, you're likely going to make that, $10 at $20. And that's a good psychological benefit as a trader to have. Um, the stop price helps define the initial risk. It really helps you define your risk reward ratio at the beginning of the trade and determine if it's a good risk or reward scenario and whether the trade's even worth putting on. Stops help protect your capital and it helps maximize your profits. As we've shown, there's many different ways to determine the stop price, and really the only way that to determine what works for you and your strategy is to backtest it and to practice it with a virtual account. Really kind of lay it out, document it, and set rules around it so that when you get into trade, so if you do use different stops for different types of stocks based on volatility, news events, whatever, you've got that documented, you've got a plan of attack, and you can follow it every time. So that's all I have for stops and stop prices. Thank you for attending tonight. Have a great evening.